Back with the markets right here on ET Now, and let me welcome on board now Mahesh Nandurkar, known for his data-driven sector calls across the 250 plus stock universe that he's been tracking here at Jefferies in India. And of course, in his latest note, he's been flagging that Brent crude has now fallen back to pre-Iran war levels and is using stock performance since Feb 27 to try and identify which sectors have over and underperformed and what's the likely trend to be. Mahesh, great to have you on ET Now once again. Thank you for your time.
Thank you, Aisha. Thank you for inviting me here.
Right. And Mahesh, I have to start talking about Brent, right? Ignoring what happened this week, midweek that is. But we're pretty much back to the pre-war levels. How much of this de-escalation trade you think is already priced into Indian equities? And how much room is left before it's fully arbitraged out?
Yeah, thanks, Aisha. It's a good question. I think from the broader market level, probably the trade has played out to a large extent. Obviously, there are some minor changes, at the stock specific level and at the sector level, which one can point out. But yeah. But the other good news, I would highlight is that, apart from the Brent coming down, which you rightly highlighted. Yeah, but also the other good news is that the economic data points are actually, holding up very nicely, and in fact much stronger than what the initial fears were. And I'm talking about numbers like credit growth numbers and auto registration numbers and auto sales volume numbers. Even the property market data points have been pretty encouraging. Yeah, so overall, I would say that this last 3, 4 months, which were quite volatile in terms of the news flow coming in from the Middle East, um, the worries that were there and the worries around how it would impact the Indian economy, I think I would say that the economy has actually done much better than what would have one feared.
Enough to bring FIIs and FPIs back, Mahesh, or are we still the funding ground for the AI trade?
Yeah, so for now, it seems like there's a bit of a change of trend. At least the FPI selling has come down last 15, 20 days. But it's too early, Aisha, I would say, to really, um, announce a victory here. Because while there are a lot of measures that have been put into place by the government as well, whether in terms of changes into the bond taxation for foreign investors and the announcement of the FCNR deposit scheme, which is likely to bring in several $billion of deposit inflows. So from the policy perspective, there have been measures in place. The economic numbers are holding up well. And yes, at the margin, the FPI numbers have turned, I would say, small positive in the last 15, 20 days or so. Um, but yeah, we have seen these types of changes in the FPI behavior in the past as well. In the sense that we have seen some of these, change in the direction of the flows have been short-lived historically. So I'm not so sure whether one can really call it, with confidence that okay, things have changed for sure. But at the same time, what I would also highlight is that one of the biggest relative negative for Indian equity markets was the booming AI as the key investment theme, which has helped the global markets, which has helped the other Asian markets like Korea and Taiwan. There seems to be a bit more scrutiny, a bit more questioning of that investment theme. Um, the economic theme of AI is going to continue for a very long period of time, but AI, the investment theme from the stock market perspective, is undergoing some scrutiny, and which is a good news. I would say once again from a relative perspective. And we can see that the Korean market is actually down almost 15 to 20% from its recent peak that we saw in June. So that has also helped to some extent to improve the foreign portfolio investor sentiments around India. Uh, but yeah, I think we'll need to still wait for some more time to see whether this is a continuing trend or the AI trade bounces back up again.
The other thing is, and it's fascinating really, the way the mid and small caps have a different bull market on, right? Irrespective of what's happening on the index. And more so in the last 1 month, since the crude reversal, the volumes and the number of stocks which are sitting at 52-week highs is only increasing as a pool. Time to tread with caution, or do you think the small and mid cap rally is still pretty much intact and has more legs to go?
Yeah, so the small and mid cap rally, I would not generalize that to generally all types of small and mid caps, although that is what is happening today and that is what it seems like. But I would say that there are certain verticals that are looking pretty interesting. So the entire power sector chain, which is right from power producers, distributors, transmission companies, the equipment sort of providers, and so on. So the entire chain that looks very, very good. Real estate theme is also looking pretty interesting. And and then there are some of the other what we call as real asset or a hard asset theme, such as the airports and the seaports, etc. That's also looking pretty interesting. So there are certain select verticals which we believe will continue to do well. But just talking about the mid cap, small cap versus the large caps, um, it's actually very interesting because if you look at the global trend or even the trend in the rest of Asia, the mega caps or the large caps as a share of total market cap globally is now at an all-time high. And in India, it's exactly the other way around, in the sense that if you look at the top 20 companies in India by market cap, and that as a percentage of total market cap of India, and we just did that exercise over the last 25 years, that ratio in the Indian context is at the lowest that we've ever seen versus the rest of the world, which is at the highest. And the key reason why India has really moved in the other direction as far as the large cap versus mid caps have behaved is the strong divergence between the earnings growth as well. So if you look at the last 2 to 3 years, the large cap earnings growth has been in single digits, 8, 9%, and the small and mid cap earnings growth has been 18 to 20%. So there's been a large 10 percentage point earnings growth gap. But over the next 2 years, we think that this gap is going to narrow. And therefore, in that sense, it makes sense to take a look at some select large cap names as well. And we think the best way to play this large cap trade is through banks and NBFCs, because that's the segment where we expect the earnings growth to improve within the large cap space.
Interesting. And I want to pick up some of those themes that you've talked about in your latest note as well. And I want to start off with cement, given that, the entire West Asia crisis was not just about crude, but a whole host of other commodities as well. And petcoke too spiked towards that $150 per barrel, per ton. Having said that, one is wondering now that Brent is normalizing, how quickly does that cost relief actually flow through to margins of, say, some of the cement companies? And do you buy them now?
Yeah, so the relief that you're talking about will probably start reflecting quite slowly. Definitely not in the June quarter. The June quarter numbers will be published or will be announced, say, over the next 1 month or so. And those numbers will still show that for cement companies, the sequential trend or even the year-on-year trend in terms of cost per ton is going to be quite adverse. Even for September quarter, I don't think it fully reverses because there has been some inventory impact, and some of these impacts do actually linger around for some time. So we will see the full benefit of the crude normalizing as far as cement companies are concerned, probably only towards the December quarter. So that is still some time away. And for the stocks to do well, in my view, what you really need to see is the traction on cement pricing, which is still not really visible as we speak. The cement volume growth has been pretty robust. And given the fact that we are going to see, or we are probably likely seeing deficient rainfall, because of El Nino. So the deficient rainfall is actually a good news for construction activity, because there's lesser disruption due to rains, and therefore higher volume growth for cement. But the cement stocks do not really move on volume growth, they move on the pricing movement, which is still not really visible. So we as a house are positive, but only moderately positive on cement.
Interesting. What about banks and NBFCs, Mahesh? Where's the tilt towards? Because clearly seems like valuation comfort is now more towards the large cap private banking names.
Oh, absolutely. I would say that the banking sector as a whole has multiple positives. One you already mentioned, which is that of the valuation. There are only a couple of sectors in India. One of those is banks, where the current valuations are well below the historical averages, especially for the private banks. So that's definitely a one big plus. But apart from that, uh, the credit growth, the broad-based industry level credit growth is at 17 to 18% mark, which is the highest that we've seen in the last 3 to 4 years, and at a significantly improved level as compared to the 9% growth that we were at exactly 1 year ago. So that's the second positive, very strong credit growth. Thirdly, the rate cut cycle by the RBI is definitely behind. Whether the RBI raises rates or otherwise, we'll see. But cuts are definitely not happening. And there's a small chance of some rate increase, which is once again a positive news for the banks in terms of the net interest margins, which was actually falling for the sector as a whole for the last 2 to 3 years. This year, FY27, we should see the net interest margins maybe holding flat and possibility of an improvement next year. So that's the third positive. The fourth positive is this whole FCNR scheme, right, which is going to improve the deposit growth for the entire banking system once again. It would be helping the NBFCs as well, but also for the banking sector. So that's the fourth positive. And the fifth one is that the asset quality is holding up very nicely. So actually, I don't see any reason why the banks should not be doing well from here on. The only technical factor that we need to watch out for is the foreign investor buying versus selling. For the last 1 year or so, the investors have been on the selling side, the foreign investors, and banking sector is one of the sectors which is heavily owned by them. So that was a technical factor. But now, for the last few weeks, as we discussed, at least the selling has come down. And even if that continues to be the case, I would say that the banking sector stock should do very well over the next 6 to 12 months.
Mahesh, what's the right way to look at some of the OMCs? Because while names like a BPIOC have outperformed the MSCI India by 17 and 21 percentage points respectively since Feb, how much of that is pure GRM tailwind from cheaper crude versus a re-rating on the OMC's pricing freedom? And does that re-rating survive if crude ticks back up before the next fuel price review? And coupled with that, one is wondering, what do you do with, say, aviation, with the paint sector, the very, very sensitive, oil-sensitive sector, so to speak?
Right. So I think OMCs definitely look very attractive within all the three names that you mentioned. My pecking order will be actually to favor the OMCs among the sectors that you mentioned, because that is one sector where the stocks are still significantly below the levels that we saw before the 27th or 28th of February, when the war in the Middle East kind of broke out. So there is a room for catch up there, uh, and given the fact that the oil has come down, and while there has been some ups and downs here and there, but I think the general trend seems to be that the oil is probably heading back or has headed back towards the pre-February numbers. So in that context, ideally the stock should also trace back to those levels. Obviously, the key question here is what has changed between now versus then is that the government has decreased the excise duties by 10 rupees. And the market worry is that whether the government takes that number back up to the pre-war levels. But my sense is that there is a good probability that um, the monies that have been lost by the OMCs over the last few months, they will be allowed to kind of recoup those losses and maybe then the government could reconsider. So I think OMCs look good. Um, the airline companies, where the oil is also a large part of the cost, would also be, looking pretty good. On the paint side, I'm not so sure because we need to track the demand for the products, and also pair that with the market trading multiples as well, which is not that attractive at this point in time, in my view.
Interesting. I have to talk about the capital marketplace, Mahesh. Given NSE's large IPO, which the timeline now seems fairly sort of confirmed, that coupled with BSE's derating close to bottoming, and one is wondering whether the market is still underpricing the competitive threat once NSE actually has listed currency and public scrutiny for its own members. And how do you look at some of the AMCs, which, again, from the March lows have done very well?
Yeah. I guess any large IPO of the size that you're mentioning has to come with some element of discount, to the current trading multiples of the comparable companies. So, yeah, and so to that extent, and also it's a large equity supply as well for the capital market sector. So I think we also have to keep in mind the possibility of the existing investors probably taking some money out of the existing capital market stocks and rotate that money into some of the new offerings that are coming through. So yeah, so I would say that the sector as a whole, I would trade with a bit of a caution. Also because we have seen some moderation in the mutual fund flow, some moderation in the in the overall domestic flows as well. So I would say that I would kind of wait and watch at this point in time. Some of the individual stocks could be very interesting. But for the broader space, I would just take a wait and watch approach as of now.
Interesting. Um, I'm just going through your note, Mahesh, and please correct me if I'm wrong. It seems like you've got one of the most contra calls on pharmaceuticals when it comes to on the street, and you've got an underperform on Cipla, DRL, Lupin at a time when, just everyone is talking about how undervalued pharma looks. And you're citing rupee strength, which you think is going to erode margins. How would you defend this view?
Well, see, the thing is, if you look at the earnings revision trajectory for many of the export-oriented pharma names, it's actually been on the negative side, and one of the big reasons why I would say these stocks, export pharma companies have done exceedingly well, is also because in the environment of a falling currency, the investors were looking at playing this through the currency hedges with some export companies and sectors. And one of the large export sectors, which is IT services, is clearly out of favor for the broader investment community, and for the right reasons. So I would say that some of these generic pharma names have benefited because of those two trends, the trends of rupee weakening and also that of the large IT services sector not really doing that well. But I think, and while that IT sector continues to be, uh, a continuing factor, but as far as the rupee outlook is concerned, we've seen the rupee has already reversed from the lows that it has seen, and with the expected inflows now likely to come through from the FCNR scheme, etc. I would say that rupee should be stable to, maybe slightly appreciating as we speak. So the big attraction of playing the currency depreciation plays, will not really be there, in our view. So within the broader healthcare sector, we will much rather prefer names like hospitals and the other domestic pharma names over the generic pharma names.
Understood. And IT services, has TCS's commentary changed any view there? Or is the valuation ripe enough now to at least start nibbling in?
The company's commentary hasn't really change the view on the sector as a whole. That continues to still be on the weaker side. But yeah, your point is valid on the valuations. The valuations have come off, quite a lot. And, as I mentioned, there is, some attraction towards looking at the large caps once again. So there is a possibility of some technical bounce in the IT service sector. I will not rule that out. But if I take a slightly longer term view of 6 months or 12 months, I would still stay away from that sector because it is, at the end of the day, a single digit EPS growth sector. And I don't think that is really going to change, over the next, 1 to 2 years, at least. So my sense is that, yes, the stocks have got derated, but I think that derating is fully justified. And I won't rule out further derating. But even if not, and even if one assumes that the multiple will sustain at the current level, but then the returns will be in line with the EPS growth, which is in single digits and not really that attractive.
Understood. So, Mahesh, where will the alpha generation in the market come in from?
So yeah, so as I mentioned, earlier, I definitely think some of the sectors that should do well is banks and NBFCs. That's on the large cap side, and some of the other real asset theme that we like, which, as I mentioned, the entire power sector chain, which is not that small, by the way, industrials. So in fact, if you put power and industrials together, the combined weight of those two sectors is easily close to 15% now. And then plus if you add other names in that space like real estate and airports and seaports, etc., yeah, it would easily be now accounting for close to 20% of the overall market in terms of the benchmark itself. And we would really be overweighting that sector or those sectors, and would easily recommend investors to, as against the benchmark weight of 20%, would easily go up to like 30 to 35% in those sectors.
Interesting. Um, what then could be the party spoiler at this juncture, then, Mahesh? What would you say would sort of prick the bubble for us and make us go back to those March lows, or I don't know where from here?
Yeah, I mean, party, I'm not so sure because we're
Yeah,
talking
I
about a
know.
really
I
short-term
wanted to
party
correct
here.
myself the minute I said party.
Yeah, so we have seen, I would say, a short-term rally since the March lows. And what can really, spoil that? I mean, see, the thing is the valuations are still on a higher side, and we still continue to see large amount of equity paper supply, right, across the capital market segments, the telecom sector, and even otherwise. And these are the IPOs, but even if you look outside the IPOs, and if you look at the follow-on offerings, the block deals, etc., that keep on happening, I think the large equity supply is still something that we need to be worried about. And the second point, is that this whole market rally over the last 1 or 2 years has clearly been driven by large domestic flows. A part of that has also been driven by some regulatory changes, which is the increased allocation under the NPS schemes and under provident fund schemes, etc. And some of those are actually one-offs, and those have largely played out. So the other thing that I would closely keep a tab on is the overall domestic inflows and whether there is any fatigue there or whether there is any slowdown there. So those are the two things that I would watch out for in terms of evaluating the downside.
Interesting. Mahesh, the other thing, of course, is the entire AI trade, right? And we did speak about that, but just drawing out the ancillaries here in India and just looking at the entire supply chain dynamics, with data centers being the mainstay and everything that comes about with it, would you say that's also instilling your confidence in power as a sector right now?
Yeah, I mean, yeah, data center is a great story, and we think that data center can add about 0.5, 0.7% to the annual power demand growth. So right now we're looking at, let's say, 5 to 6%, which is what we have seen historically. But if the data center boom were to unfold the way it's expected as of now could add about 50-70 basis points to the demand growth. Then also there is this thing about electrification, right? Because now the government is also uh, pushing towards more electrification, and especially after what we've seen happening in the in the recent war. I think there's a greater need for India to kind of reduce its dependence on oil as much as possible, and therefore giving a boost to electrification, which in turn can further give another boost to the power demand growth as well. So all those things are playing into our bullish view on the power sector.
Okay, interesting. Mahesh, always good chatting you. A lot of food for thought for our viewers and, of course, investors out there as well. Good to be speaking with you.
Thank you for having me here.